Welcome to Investor's Guide. Thank you so much for tuning in. We're going to help you through the next half an hour figure out what's going on with this very complicated market. And we're going to help you decide what you should be doing as an investor when it comes to your money. Remember, if you have to ask us any questions at all, write to us. Email IDs at the bottom of your screen, and you can reach me personally on Twitter. On the show this week, we'll begin with helping a woman investor build enough of a medical corpus for post-retirement. In our product review, we look at the Axis Midcap Fund. We help investors understand capital gains tax. All right, let me bring in Dhirendra Kumar. None of this is possible without Dhirendra joining us on the show. Dhirendra, thank you so much for joining us.
Thank you.
Our first question comes in from a woman investor. Sonika K has written in, Dhirendra, she wants to save for her child's education, her own retirement, and to build a medical corpus, she says, post-retirement. She sent her financial details of both herself and her husband. She hasn't told us how old she is, so it makes it a little difficult for us to, estimate how much time she has before her retirement. But we'll try and help her out. She has a short-term debt fund of 6 lakh rupees, a salary of 65 lakh rupees a year, including what her husband makes, rental income of 2.4 lakh rupees per year, and annual expenses, she said, about 10 lakh rupees. She's got one apartment in Bangalore. There is the EPF with gratuity, 1.6 crore rupees in equity, gold of 3.2 lakh rupees, and insurance investments as well. It seems like their insurance and their emergency fund seems taken care of. She's also sent us a list of her mutual funds, Dhirendra, but before we get into her mutual funds, it does seem like this is a family that's put some careful thought into all of their investments. Going by the larger goals that they have, their own retirement, the children's education overseas, do you think they largely seem on track?
Yeah, seems very well on track, and also it's very well oriented in the sense that they have having the understanding that equity should be a larger allocation when you have the time. And given the age of their child, I hope that most of their goals are is at least 10 years away, and so in that sense, it is reasonably taken care of. One thing which just to bring in greater objectivity, that they themselves they are targeting an asset allocation of 90% into equity and 10% into fixed income. Take a full picture: your gratuity estimates, your EPF accumulation so far, and your investment in fixed income. Look at it as one part, and that is something which is not going to beat inflation, but it is going to provide you stability. So don't overdo it, and maybe at some point you just want to be more conservative. Have a small so have that allocation. All I'm saying is that look at broadly two asset classes, equity and fixed income. And you don't need fixed income for income right now, and you are unlikely to need fixed income for next 10 years or till your retirement, because your current income is more than enough. In fact, you are accumulating your savings. So from that standpoint, take a holistic view of your full portfolio. Look at your fixed income, take into account your EPF and gratuity accumulation, and don't have more than needed, and as emergency fund and other things are already taken care of nicely. Just have a focused portfolio of a low maintenance equity portfolio.
Dhirendra, if we take a look at their equity funds, and you did say, of course, to have a low maintenance, easy to manage portfolio, there are about 9 funds. A large chunk of that investment that's going in to equities in the US focused blue chip, the ICICI Prudential US focused blue chip fund. This could possibly be also because they've told us they want both of their children to go overseas for studies, so they're looking at creating a dollar denomination investment. Would you like them to streamline it? Is 9 funds too many, or are you happy with the design of that portfolio right now?
No, they have actually chosen great funds, but I would still suggest to at least drop 2 or 3 funds. One is that there's no role of a gold fund here. Your equity fund investment will generate so much return over the next 10-15 years that you can go and buy more gold than the money which is going into the gold fund. So it is better to have it there. Likewise, Axis Triple Advantage kind of fund does not justify a place in your portfolio, which is very well structured. And likewise, the fixed income portfolio, first you take a call, taking a holistic view, taking into account your EPF and other things, that do you want this much of allocation to fixed income, and either drop both if you have enough fixed income in your portfolio otherwise, else just have one, because fixed income funds over a period of time, and particularly in your portfolio, is there not to generate income but to provide stability to the overall portfolio. and look at its role rather than the kind of return, and you don't need to diversify beyond a point. So I would say that once you drop the three or four funds, the fund chosen are good enough, and over a full market cycle, they are the kind of low maintenance fund which I'm referring to, funds which are likely to invest across the market.
Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review. And we're looking at the Axis Midcap Fund. Avan has a quick introduction. Avan.
Thanks, Faye. This week, we take a look at mid and small cap fund, the Axis Midcap. Now, this fund has a multi-cap allocation and therefore invests in medium and small cap companies. With 1,262 crore rupees as assets under management, this fund was launched in the year 2011, making it a relatively newer fund in its category. Let's take a look at its performance chart over the last 5 years. The red line is the fund and the blue line is the benchmark, the BSE Midcap. You'll see that the fund has outperformed its benchmark by a margin in both the bull and the bear phases of the market. However, the last 1 year has been particularly unfavorable for the fund, putting it at the bottom of the pack in its category. In fact, you'll see that while the benchmark gave a return of 10%, the fund had a return of below 1%. A quick peer comparison shows that the fund's performance has actually been drastically lower than the rest of the funds in its category. The fund that is heavily invested in healthcare and financial services does not have a good long-term track record as against its peers either. If you're an existing investor, is it time to exit this fund and switch to a better performing fund? Let's find out. With that, it's back to you, Faye.
All right, Avan. Dhirendra, if we look at this fund right now, 2 stars on value research is normally enough reason to sort of just give it a miss for most investors. When we started off, this seemed like an interesting fund. It was mentioned a couple of times on the show. Has its performance dropped so drastically in the last 1 year?
Yes, this fund has been extremely disappointing through 2015. And 2015, one can say that it was a year of small and mid-cap stocks, and selectivity was at work, was able to deliver it, and many funds did. But this fund actually turned conservative, and at the same time, it could not withstand. So if you look at it, 2015 was a disappointing year. It was unable to beat, it could not match its benchmark by a wide margin. It slipped on relative performance in the category, so relative to other funds, and it remained volatile compared to other funds in the category. That led to a drastic, downgrade on the rating scale. So yes, things have turned out to be not so good for this fund over the last 12-15 months.
Dhirendra, the other thing that I find very interesting about this fund, it's of course the Axis Midcap Fund. But if we look at the way it's been categorized on value research, it falls into the small cap category. Is there some confusion there about what sort of assets this fund will hold?
No, the classification at value research is entirely driven by numbers. We try and look at the the underlying portfolio. We do an average over the last 18 months and try to arrive at where it whether it is a small cap company. If it was a company, then whether it should be a small cap company or a mid cap company. So its name is mid-cap, but based on we are comparing with similar kind of funds in the mutual fund universe, and on that scale, it is not stacking up. And if within this category, if you look at it, 2015 was particularly disappointing. It was at the bottom of the pack of 41 funds.
All right, Dhirendra, finally, your rating of the Axis Midcap Fund, and for those viewers who are watching right now, would you recommend they stay invested?
No, there are superior options, and I think selectivity here on a continuous basis matters more. But I would be a little more, charitable with this fund, because when I look at the portfolio, I don't see greatly, questionable things. On the risk-adjusted scale, it is 2-star, but I would say that it's proving to be an average fund, and it will have its, day some other time. I'll slot it as a 3-star fund on our rating.
All right, 3 stars there for the Axis Midcap Fund on Investors Guide. Let's move on to our hold or sell segment. 27-year-old Yogesh has written in Dhirendra. He's investing 15,000 rupees a month in mutual funds to create wealth of 40 to 50 lakh rupees for a home that he wants to buy over the next 10 years. He sent us a list of his funds. He wants to know if these are the funds that will take him to that target. The UTI MNC fund is the first on his list, Dhirendra. Would you recommend he continues that investment?
Ideally, I suggest that you diversify, and MNC fund is reasonably diversified, but not completely, and it's a constrained portfolio. But yes, it has turned out to be a decent fund and a fairly conservative fund.
The Birla Sun Life Top 100 fund is also on his list, Dhirendra. Continue that investment as well?
Yeah, this too is evolving as a fairly well diversified and large cap oriented fund, and worth carrying on.
Axis Long Term Equity is also on his list, Dhirendra. Continue this investment as well?
Yeah, this is a fund which remains as part of our tax saving fund recommendations, and it's a reasonably impressive fund. Though it has this fund also had its lean period recently, but don't look at a short time period while evaluating such a fund. It will have its time, and anyway, it's a tax saving fund worth carrying on, and have a long term view here.
The JP Morgan Mid and Small Cap Fund is the next on his list. Of all of the options available within that category, is this the best one for him?
No, not really. This is a category where we have very promising funds, and the very well performing fund, we have even a much longer history to look at, and how it has done over a full cycle. But more importantly, when investing in such a fund, these are testing times. Make sure that you really have the appetite. Last 1.5 to 2 years, you never know, the market did not present an opportunity to validate your appetite for such a fund. Right now it is. So reconsider it. The general anybody's investment in mid and small cap fund, one should be considering that, are you really cut out for that? But there are superior options here.
Last on the list is the SBI Pharma Fund, Dhirendra. We saw Pharma take a bit of a beating this week, especially in the market. This is a sort of a learning for all investors right now to steer clear of these sort of specific funds?
Actually, Pharma Fund is an exception in a sense that, we have, the long-term performance of Pharma Fund looks so outstanding that when I suggest that when you invest in a fund, your rationale is to diversify. The kind of market that we have seen in the last 1 or 2 years, the pharma funds have done so well that investors are not easily buying into this theory. But I think it's a matter of belief, it's a matter of conviction. I think the reason why you should not invest in a sector fund is that is why you don't invest in a mutual fund. You invest in a mutual fund to diversify. And there will be times when any sector fund will, sector funds are always at the top of the pack or at the bottom of the pack, never in between. And the whole idea of investing in a mutual fund is to be in between over a longer period of time and never be at the top or at the bottom. So from that standpoint, it's a matter of principle, what you want to achieve. And I think investors are not chasing short-term return when investing in mutual funds. So that's the reason why one should not, and nothing constrains a fund to be investing in pharma companies. Anyway, it should not be a large part of your portfolio. The role of a pharma fund or any sector fund is only if you have some specialist understanding that you need to tilt your portfolio towards something, and you don't find it to be enough, sufficiently represented in your portfolio. That is the only reason why you should have a sector fund, else not.
So the pharma fund you might want to replace in that portfolio. There is a very quick question coming in from 27-year-old Vaibhav Gupta. He wants to invest 10,000 rupees a month in tax savers. He selected Axis Long Term, the Birla Sun Life Tax Relief. He wants to know if he's on the right track for that time horizon. He says most of these funds perform well in a 3-year term or a 5-year term, but if he's going to invest all of this money for such a long term, are these the funds that he should be using? I
think so, and he should do it with a belief. And it's very difficult to predict that which will actually generate the best performing return over the next 5 years. So it is an exercise of elimination. So if you have actually eliminated a number of funds with relatively, in fact, when looking at a 5-year term or more, one thing which is quite counterintuitive is that more volatile the performance, the better the return of a SIP will be in such a fund. So if you're coming across, if you're sure that you're going to choose a fund and be disciplined with your SIP, then consider the one which is the most volatile fund. You know, the aggressive tax saver selection might turn out to be more rewarding.
All right, Dhirendra, many thanks for joining us on Investors Guide this week and helping us understand what's going on in our stock market.
Thank you.
Welcome back. You're watching Investors Guide in ET Now. Thank you for staying with us. Suresh Surana has joined us on the show right now to answer your questions on tax. Our first question comes in from Ajay. Ajay wants to know if the NPS is a good option to save tax. For those of us who are in the 30% tax bracket, he says he recently came to know that the returns of the NPS are taxable. What would you recommend, Suresh? Well, on one hand, the NPS has that equity allocation, which makes it attractive, plus the added 50,000 rupee tax benefit. So would you recommend he goes ahead and invests anyway?
Yes, so Mr. Ajay Jain, I think that's a very now relevant question, because from this financial year 15-16, there is an additional deduction available of rupees 50,000 for any contribution to the National Pension Scheme under section 80cc D1B. There is a special provision now, but you should actually claim this deduction after you have exhausted the deduction under section 80C, because when you make an investment under section 80C, even when you receive the amount on maturity or on redemption, that is not subject to tax. So like for example, if you are investing in public provident fund, what you receive on maturity is not taxable. Or similarly for equity linked savings scheme. So under section 80C, there is a deduction of 1,50,000 rupees, which you should claim first. After you exhaust that, then you can claim this additional deduction of 50,000 rupees for the National Pension Scheme, in which case you will get the deduction right now in the year of contribution, but in the year when you withdraw this amount, it will become taxable for you. So that is the reason why I am saying that it is important for you to make sure first you exhaust section 80C, and then definitely this will be an additional benefit available to you.
Next question comes in from Ramahalli Mahadeva. He tells us he's a pensioner drawing a pension of 3.5 lakh rupees a year. He is also trading in equities and he wants to know if he's liable to pay income tax after paying 15% capital gains tax.
So it really depends upon what is your total taxable income. Now, assuming that you are already having 3.5 lakhs rupees of income from pension, and if you have further income from shares by way of short-term capital gains, and if you are not a super senior citizen, which is more than 80 years of age, then the basic exemption limit available to you is rupees 3 lakhs, and you are already above that limit. So whatever is your, you have to compute your total income from pension as well as from the short-term capital gain, and file your tax return and pay the tax, which would be 15% on the short-term capital gains, and on the pension income probably already tax would have been deducted and form 16 would be available to you. If you are more than 80 years of age, then the basic exemption limit is 5 lakh rupees. So you need to see if your short-term capital gain is less than rupees 1.5 lakhs and pension income is 3.5 lakhs, you may be below the taxable limit. If it is more than 5 lakhs put together, then again you will have to pay the tax in a similar manner.
Last question comes in from SJ Hari. He wants to know if he can use the benefit of indexation on the bonds that he bought from Navad Bhavishya Nirman bonds. These are the zero coupon bonds. He also wants to know if the appreciation between the maturity amount and the face value will be taxed at 10%, which is a flat rate, or 20% after indexation.
So, Mr. Hari, the Nabard, the Bhavishya Nirman bond is a 10-year bond. It is also listed bond. So basically, and it's a zero coupon bond. So in this case, you would not be eligible to claim the benefit of indexation. There is a specific provision in section 48, so you cannot claim the benefit of indexation. However, you will be able to claim the lower rate of tax of 10% under section 112, and so therefore basically you can claim the benefit of 10% tax rate, but without indexation.
All right, remember, if you have questions about taxation, you can write to us. Our email ID is at the bottom of your screen. We'll have Suresh come back into the studio and answer those questions for you. Thank you so much for watching Investors Guide. Get in touch if you need any help. We're going to be right here. You'll find a copy of this show on our Facebook page as well. Thank you so much for watching.